In the life of every great speculator, there are moments that defy simple logic. They are instances of profound, almost clairvoyant insight, a sudden and overwhelming conviction that appears as if from nowhere. The amateur calls it a hunch, a lucky guess. The cynical observer calls it a fiction, a story told in retrospect to romanticize a random bet. But for the master, for the man who has spent a lifetime immersed in the subtle language of the market, it is something more. It is the speculator's sixth sense, a mysterious but powerful force that he must learn to understand, to respect, and, under a strict set of rules, to trust. Jesse Livermore, the most formidable speculator of his age, was no stranger to these powerful, irresistible impulses. He was a man of science, a tireless student of facts, figures, and historical precedents. Yet he admitted throughout his career that some of his greatest and most profitable trades were initiated not by a cold, analytical process, but by a sudden, inexplicable feeling of certainty, a hunch so powerful that it could not be ignored. He did not dismiss these feelings as mere foolishness. He studied them, he wrestled with them, and he developed a set of powerful rules for determining when to trust this mysterious inner voice and when to dismiss it as a dangerous emotional whim. This is not a story about magic or market sorcery. It is a deep dive into the psychology of a master, an exploration of the true nature of a speculator's intuition. It is a guide to understanding what a hunch really is, and a revelation of the three critical rules that Livermore used to harness its power, transforming a mysterious impulse into a calculated, strategic, and often spectacularly profitable weapon. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. What then is this sixth sense, this speculator's hunch? Livermore himself did not believe it was a message from the supernatural. It was, he came to believe, the product of his own highly trained subconscious mind. After spending decades staring at the ticker tape, after observing millions of individual price fluctuations, his mind had developed an almost instantaneous pattern recognition ability that operated far below the level of his conscious thought. He explained it this way. I think what happens is that I see a lot of warning signals. Perhaps not a single one may be sufficiently clear or powerful to afford me a positive, definite reason for doing what I suddenly feel like doing. It was not one great, obvious signal, but 100 small, subtle, and almost invisible signs. The way a stock absorbed selling pressure, the slight hesitation in its advance, the changing character of the volume, that his subconscious mind would instantly process. The conscious mind might not be able to articulate the reason, but the deep, intuitive part of his brain, the part that had been trained by a lifetime of observation, would deliver its verdict in the form of a single powerful feeling. Something is wrong, or the time to act is now. Livermore's genius was in learning to trust this deep, intuitive part of himself, to let his ticker sense guide him. But one of his great contemporaries, the legendary William Gann, sought to conquer the same great puzzle of market timing through a completely different and far more esoteric method. While Livermore learned to feel the market's intentions through his highly developed intuition, Gann believed he could forecast them with mathematical precision. He saw the market not as a psychological battlefield, but as a great harmonious clock, governed by a natural vibratory law of price and time. If you wish to explore this fascinating and complex world, to understand the hidden cycles that Gann believed were the market's secret code, we invite you to subscribe to our new channel, William Gann Trading Insights. The link is in the description below. This brings us to the first and most important of Livermore's 3 rules for trusting a hunch, a rule designed to protect the speculator from the most dangerous of all impulses, wishful thinking. Rule number 1. The hunch must align with the primary market trend. A true speculator's sixth sense is not an act of ego-driven defiance against the market. It is not the desire to be a lone hero, to call the absolute top of a bull market or the absolute bottom of a bear market. It is a subtle signal that is in harmony with the great underlying line of least resistance. If the primary market is in a great bull trend, a sudden, powerful hunch to buy a leading stock as it hesitates at a key level is a signal that deserves the highest respect. It is very likely the speculator's subconscious mind recognizing the final quiet phase of accumulation before the next great advance. The great probabilities of the market are already on his side, and the hunch is merely the final, refined timing signal. But a hunch to buy that same stock in the midst of a confirmed raging bear market is an entirely different and far more dangerous thing. It is, in all probability, not a true speculator's sixth sense at all. It is simply hope, the speculator's deadliest enemy, dressing itself up in the clothes of intuition. It is the gambler's desperate wish for a miraculous reversal, not the professional's quiet recognition of a confirmed opportunity. Livermore knew that a man can have the courage of his convictions, but he must first have the intelligence and the honesty to be sure that his conviction is not merely a disguised hope. Therefore, the first test of any hunch is to ask, does this feeling align with the facts of the primary trend? If the answer is yes, the hunch may be a genuine and valuable signal. If the answer is no, it is to be dismissed immediately as a dangerous emotional whim. The true speculator's intuition is a tool for navigating the great current of the market, not for trying to swim against it. Having established the first great rule of the speculator's sixth sense, that a true, actionable hunch must always be in harmony with the great primary trend of the market, we now arrive at the critical tactical phase. A hunch, however powerful, is not a license for recklessness. It is a hypothesis, a high probability supposition that must still be subjected to the cold, hard, and final verdict of the ticker tape. The amateur, seized by a sudden conviction, is tempted to plunge, to commit his entire capital in one heroic bet. The professional knows this is a fool's game. How then does a master speculator act on this mysterious internal signal without abandoning the principles of sound risk management? This brings us to the second and most practical of Livermore's rules. Rule number 2. The hunch must be tested, not blindly followed. This is the great mechanical safeguard, the principle that transforms a mysterious impulse from a wild gamble into a calculated scientific probe. Livermore, for all his reputation as a plunger, never went all in on a feeling. To act on a hunch did not mean committing his entire army. It meant sending out a single, small, and ultimately expendable scout. His method was simple and unwavering. He would test his hunch with a small exploratory position, a probe. This initial trade was not intended to make him a fortune. Its sole purpose was to gather information at the lowest possible cost. It was his way of translating a subjective feeling into an objective question he could ask the market directly. Is this feeling real? Is the market ready to confirm what my subconscious mind is telling me? The risk on this probe was always small, always predetermined, and always an amount he was perfectly willing to lose for the invaluable information it would provide. This is where the third and final component of the test comes into play. Immediate confirmation. The tape must almost instantly validate the hunch. If he acted on a powerful impulse to sell a stock, he had to see the price begin to weaken immediately. He had to feel the selling pressure, the lack of support. The tape's action had to harmonize with his internal feeling. If he saw this, it was the market's own confirmation that his sixth sense was correct. The unseen forces his subconscious had detected were now making themselves visible on the tape. If, however, he sold his small probe and the stock refused to go down, if it held firm or worse began to rally, it was an equally clear and immediate signal. His hunch had been a false one. It was a phantom, a trick of the mind. In this scenario, he would not wait. He would not hope. He would not argue. He would accept the market's verdict and close the position, taking the small, insignificant loss on his probe without a second thought. The test had failed. and the campaign was over before it had a chance to inflict any real damage. This process of probing and demanding immediate confirmation was the great scientific method he applied to the unscientific art of the hunch. The story of how he acted before the great San Francisco earthquake of 1906 is the ultimate and most dramatic illustration of this entire process in action. He was in Atlantic City, taking a vacation, completely out of the market. The general trend was bullish, and he had no intention of trading. One morning in his broker's branch office, while casually watching the quotations, he was suddenly seized by a feeling he could not explain. He was staring at the price of Union Pacific, and he felt an irresistible impulse to sell it. "I can't tell you more," he recounted. "I just felt like selling it." There was no news, no reason, no logical basis for this sudden bearish conviction. The market was strong, and Union Pacific was one of its leaders. His conscious, analytical mind could find no fault with the stock. But his subconscious, his deep tape-reading instinct was screaming a warning. He did not know why he wanted to sell it, he only knew that he had to. He did not, however, rush in and sell his entire fortune. He followed his rule. He began with a probe. He wrote out an order to sell 1,000 shares of Union Pacific. This was a significant amount, but for him it was a test, a way to ask the market if his strange feeling was real. But the feeling did not subside. In fact, it grew stronger. The urge was so strong, he said, that he sold another 1,000, and then a third. He had now committed a substantial line, 3,000 shares based on nothing more than a powerful, inexplicable feeling. His friend who was with him thought he was crazy. "Stark crazy," he said, "selling that stock without rhyme or reason." Livermore could offer no defense, no logical explanation. All he knew was that he had learned, through costly experience, to respect these powerful internal signals. He had built his initial position, his bet on his own sixth sense. Now he had to wait for the market and the world to deliver its verdict. The next day, the preliminary garbled reports of a great earthquake in San Francisco began to trickle in. At first, the market, in its arrogance, ignored them. But as the full, horrific scope of the disaster became clear, the fires, the destruction, the complete paralysis of a great American city, Wall Street finally awoke to the terrible reality. The market began to collapse. Livermore's hunch had been a premonition, a subconscious recognition that some great unseen disaster was in the air. The news of the earthquake was the confirmation of what his sixth sense had already told him. And now, with his position proven correct by this terrible event, he did what a professional speculator must always do. He pressed his advantage for all it was worth. He sold more and more and more, his confidence no longer based on a mysterious feeling, but on the cold, hard, unshakable facts of the situation. From that single, inexplicable hunch, tested with a cautious probe and confirmed by a world-changing event, he made a profit of $250,000. It was the ultimate testament to the power of a disciplined intuition. Having now established the first two great rules of the speculator's sixth sense, that a true, actionable hunch must always be in harmony with the primary trend of the market, and that it must always be tested with a small, cautious, and low-risk probe, we arrive at the final and most difficult hurdle. It is a purely psychological obstacle, the last great battle that a speculator must fight in the quiet, solitary arena of his own mind. It is the battle between the quiet, powerful whisper of his trained intuition and the loud, logical, and often cowardly voice of his own reason. This brings us to the third and final rule for trusting a hunch. Rule number 3. You must act on it, not argue with it. Jesse Livermore learned through a lifetime of costly regrets that once a hunch had passed the first two tests, once it was aligned with the great underlying conditions and had been validated by the market's initial positive reaction to his probe, to then hesitate, to doubt, to overanalyze, was a fatal and expensive error. He had done the work. He had received his signal. The time for debate was over. The time for action had arrived. He stated it with the simple, profound clarity of a man who had paid dearly for the lesson. When I have argued myself into disregarding my impulse, and have stood pat, I have always had cause to regret it. This is the great and tragic sin of disbelief. The speculator does all the hard work of observation and analysis. His subconscious mind delivers a brilliant and timely conclusion in the form of a hunch. He confirms it with a successful probe. And then, at the very last moment, he allows his conscious reasoning mind to talk him out of it. This is the great danger of overanalysis. The conscious mind is a creature of logic and reason. It demands clear, articulated, and provable causes for every effect. But the speculator's sixth sense, as we have established, operates on a different level. It is the product of 1,000 subtle, almost invisible signals, a conclusion reached by the deep, pattern-recognizing part of the brain that cannot always explain its reasoning in simple, logical terms. To demand a clear, simple reason from a deep, complex intuition is to ask a master painter to explain his genius with a simple mathematical formula. It cannot be done. The speculator who has reached this final stage must have the courage to trust his own accumulated subconscious experience. He must have the faith to act on the verdict of the ticker sense that he has spent years and perhaps millions to develop. He must understand that at these critical moments his logical, reasoning mind, with its endless what-ifs and its need for absolute certainty, is not his ally. It is his enemy. It is the voice of doubt, of hesitation, of fear. The story of his trade in Union Pacific at Saratoga is the ultimate cautionary tale of this very sin. His own tape-reading sense, his profound intuitive feel for the market, told him the stock was being accumulated and was destined to go much higher. He was right. But he allowed a well-meaning and logical friend, a man with a plausible, reasoned argument, to talk him out of his own correct, intuitive conviction. He abandoned his hunch, he sold his stock, and he even went short. He listened to another man's logic instead of his own sixth sense, and the mistake cost him a fortune. It was a lesson he never forgot. This, then, is the complete three-part system for harnessing the power of the speculator's sixth sense. It is not a blind, reckless plunge into the unknown. It is a disciplined, logical, and psychologically sound process. It is a checklist that transforms a mysterious feeling into a professional, high-probability trade. Before acting on any hunch, the master speculator asks himself these three questions. First, does this feeling align with the great primary trend of the market? Is it a confirmation of the line of least resistance, or is it merely my own hope fighting against the tide? Second, can I test this feeling safely? Can I send out a small, low-risk probe to demand an immediate and inexpensive confirmation from the market itself? And finally, if the answer to the first two questions is a clear and resounding yes, he must ask the final and most difficult question. Do I have the courage to act on my own judgment, to trust my own accumulated experience, and to see this through? The man who can answer yes to all three of these questions is the man who has mastered the art of the hunch. He has learned to distinguish true intuition from emotional impulse. He has learned to manage the risk of the unknown. And he has learned to conquer the final internal enemy of self-doubt. He has, in essence, mastered himself. This is the final and highest stage of the mental game. It is the understanding that speculation is not just a battle against the market, but a lifelong war against oneself. It is the slow, difficult, and often painful process of forging a mind that is as sharp as a surgeon's scalpel, as patient as a waiting predator, and as disciplined as a master craftsman. The ultimate victory is not a single giant profit. It is the quiet, profound, and lasting satisfaction of achieving this state of self-control. To truly understand the mind of the man who waged this internal battle more intensely than any other, to witness the epic market campaigns where these very sins were committed and ultimately conquered, the essential chronicle remains Edwin Lefebvre's 1923 masterpiece. Reminiscences of a Stock Operator. This is not merely a book. It is the closest thing a speculator can get to a flight simulator for the human mind. In its pages, you do not just read about Jesse Livermore's triumphs and disasters. You live them. You feel the gut-wrenching pain of his greatest blunders and the quiet, profound satisfaction of his most brilliant campaigns. For those truly committed to this deep study, we highly recommend the edition, which includes a unique, detailed chapter-by-chapter analysis by Max Davidson. This analysis acts as your co-pilot, translating the century-old wisdom of the text into a clear, actionable roadmap for the modern trader, ensuring that the lessons learned in 1923 are as powerful and as profitable today as they were then. A link to this essential edition is provided in the description below. The stock market is a battlefield of the mind. It is an arena where the greatest contest is not fought against the ticker tape, the insiders, or the machinations of the great financial powers, but against the deeply ingrained primal forces that reside within the speculator himself. Two of these forces, more powerful than any bull pool or bear syndicate, govern the fate of every man who dares to play the game. They are greed and its twin brother, fear. To conquer the market, one must first conquer these titans of human nature. Jesse Livermore's long and tumultuous career was a testament to this singular truth. He learned at a cost that few men could bear that the mental game was the whole game. He saw that the average speculator is not ruined by the market, but by his own undisciplined human reactions to it. He is a slave to his emotions, his decisions dictated not by cold, hard logic, but by the intoxicating rush of greed or the paralyzing grip of fear. These forces, Livermore insisted, are the speculator's deadliest enemies, always boring from within. They cloud his judgment, distort his perception of reality, and compel him to commit the same catastrophic errors over and over again in a relentless and predictable cycle of ruin. The game of speculation, Livermore concluded, is not a game for the stupid, the mentally lazy, the man of inferior emotional balance, nor for the get-rich-quick adventurer. They will die poor. This was not an arrogant boast. It was a cold clinical diagnosis of the mental and psychological fortitude required to survive, let alone prosper, in the most challenging business on earth. He knew that to win, a man had to wage a constant, unending war against himself. For those who are committed to a deeper, more methodical study of the principles that governed Livermore's legendary career, the essential text remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. Let us first dissect the more obvious of these two great enemies. Fear. Fear in the market manifests in many forms, each one uniquely destructive to the speculator's account. The most common is the fear of giving back a profit. A trader enters a position and it moves in his favor. He sees a small, quick gain on paper. At that very moment, a cold fear begins to creep into his mind. He becomes terrified that the next tick of the tape will erase his fragile winnings. They say you never grow poor taking a profit, he tells himself, and in a spasm of fear, he sells, snatching a meager gain. Livermore saw this as one of the greatest tragedies of the amateur speculator. He had witnessed countless men, himself included in his early days, take a paltry 4-point profit in the heart of a great bull market, only to watch in agony as the stock continued its relentless climb for another 50 or 100 points. Fear, he learned, keeps a man from making as much money as he ought to. The big money, the fortune-making money, is not in the small, nervous fluctuations. It is in the great sweeping trends. And to capture those trends, a speculator must have the courage to sit tight, to ride through the minor reactions, a feat that is impossible for the man whose decisions are governed by fear. This fear creates a paradox. The trader is afraid of losing the profit he has, so he sells. But in doing so, he guarantees that he will never have a large profit. He is perpetually trading for a pittance, for a week's wages, while the great opportunities, the ones that could truly change his financial destiny, pass him by. He is so focused on avoiding small losses of profit that he ensures he will never achieve a great victory. Another form of fear is the fear of the unknown, the fear that paralyzes a trader and prevents him from acting on a clear signal. He may see a perfect setup, a textbook pivotal point, but he hesitates. He is afraid of being wrong. He waits for more confirmation, for more certainty, until the opportunity has vanished, the great move having already begun without him. This fear of pulling the trigger is just as costly as the fear that causes one to sell too soon. There is also the fear that is born of a losing streak. After a series of painful losses, a trader's confidence is shattered. He becomes afraid of the market itself. Every small move against him is seen as a confirmation of his own incompetence. He begins to trade with a timidity that is fatal. He cuts his winners even faster, and he hesitates even longer at new entry points. Fear has broken his nerve, and a speculator without nerve is a man without a profession. But the most insidious enemy of all, the one that works in perfect destructive harmony with fear, is greed. Greed is the force that drives the public into the market at the very peak of a boom. It is the desire to get something for nothing, the belief in the myth of easy money. The average man, having watched a stock double or triple in price, is finally consumed by an unbearable greed, a desperate need to participate in the seemingly effortless creation of wealth. It is at this moment of maximum public greed that the smart money, the insiders and the professional operators, are quietly distributing their lines, selling their stock to the very people who are just now discovering its virtues. Greed destroys the speculator's sense of proportion. It compels him to overtrade, to risk far too much of his capital on a single bet. It deafens him to the quiet voice of caution and the clear warnings of the tape. He is no longer analyzing the market. He is fantasizing about the riches it will bring him. This is the state of mind that precedes every great market top and every subsequent collapse. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Furthermore, we recognize that the wisdom of the markets is not confined to a single individual. The history of speculation is rich with masters who, while sharing Livermore's core respect for risk, developed their own unique styles. From the mechanical box theory of Nicholas Darvas, to the volume spread analysis of Richard Wyckoff, to the turtle trading system of Richard Dennis. From the deep value principles of Peter Lynch, to the pioneering trend analysis of Charles Dow and the modern psychological insights of Ed Sikota. There is a pantheon of genius to study. To explore this rich history, we have launched a new channel dedicated to the diverse strategies of the world's greatest traders and investors. If you wish to broaden your understanding, the link to this new channel is in the description below. Yet, as destructive as fear and greed are, Livermore identified a third emotion, a close cousin to both, that he considered the most dangerous of all. That emotion was hope. Hope is the great siren of the losing trade. It is the comforting, reassuring whisper that keeps a man chained to a mistake, that convinces him to hold on to a losing position in the blind faith that it will come back. When a speculator is in a losing trade, he does not need more courage or more tenacity. He needs an immediate and rational fear of a greater loss, but instead he is filled with hope. Livermore stated it as a fundamental law of market psychology. In speculation, when the market goes against you, you hope that every day will be the last day, and you lose more than you should had you not listened to hope. This hope is what fuels the catastrophic practice of averaging down. It is what allows a small, manageable loss, which should have been cut without a second thought, to fester and grow into an account-destroying disaster. Wishful thinking, he insisted, must be banished. This creates the great, tragic paradox of the amateur trader. His emotional responses are perfectly, fatally inverted. When he has a profit, he is fearful, and so he sells too soon. When he has a loss, he is hopeful, and so he holds on too long. He is afraid when he should be hopeful, and hopeful when he should be terrified. This, Livermore knew, was the central psychological flaw he had to conquer. He had to learn to do the exact opposite of what his natural human instincts were screaming at him to do. He had to master the mental game. For the speculator who has finally recognized the destructive, inverted nature of his own emotions, the path forward becomes clear, though it is by no means easy. The solution is not to find a better system for predicting the market, but to forge a new system for controlling oneself. Jesse Livermore, through a lifetime of introspection and costly self-discovery, did not eliminate fear and hope from his trading. Instead, he performed a profound act of psychological alchemy. He took these two primal, destructive forces and inverted them, transforming them from his greatest enemies into his most powerful and trusted allies. This was the true secret to the mental game he mastered. He began with the most destructive emotion of all for a losing speculator: hope. He recognized it as a poison, a comforting lie that kept a man chained to his mistakes. He knew he had to replace it. And so, where the amateur felt hope, Livermore taught himself to feel a cold, rational, and supremely useful fear. He was not afraid of the market, but he was deeply, profoundly afraid of a small loss growing into a large one. This was not a paralyzing fear, but a motivating one. It was the fear that a prudent businessman feels when he sees a small, correctable error in his inventory that, if left unattended, could bankrupt his entire enterprise. This cultivated fear became the engine of his most famous and important rule: to cut losses quickly. When a trade went against him, he did not feel the comforting warmth of hope that it would come back. He felt a chilling sense of danger. He saw the small loss not as a temporary setback, but as the potential beginning of a catastrophic decline. This fear was his call to action, his internal alarm bell that screamed, "Get out now!" It allowed him to amputate a losing trade with the swift, dispassionate precision of a surgeon, long before it could threaten the health of his overall capital. He stated with the gravity of a man who had ignored this rule to his own ruin, that being wrong and not taking the loss is what does the damage to the pocketbook and to the soul. By learning to fear the loss, he protected both. The small financial cost of being wrong was insignificant compared to the immense psychological cost of staying wrong. He knew that a man burdened by a large, festering loss could not think clearly, could not see new opportunities, and was, for all practical purposes, already out of the game. This fear was, in essence, a profound respect for the market's power and a deep humility about his own fallibility. He knew he could be wrong. He expected to be wrong a significant portion of the time. His strategy was not built on the arrogant assumption of being right, but on the realistic, business-like assumption of managing the consequences of being wrong. To fear the loss was to acknowledge this reality and to act in accordance with it. Now consider the other side of this great psychological inversion. While the amateur in a losing trade is filled with hope, in a winning trade, he is filled with fear. He is terrified that his fragile paper profit will vanish. This fear compels him to sell too soon, to snatch a meager gain from what could have been a fortune-making move. He is afraid when he should be at his most confident and courageous. Here, too, Livermore did the exact opposite. Where the amateur felt fear, Livermore taught himself to feel a powerful and intelligent hope. This was not the blind, desperate hope of the gambler. It was a calculated, confident hope, born of the market's own confirmation. A profit, in his eyes, was the market's clear, unambiguous signal that his initial judgment had been correct. He was aligned with the line of least resistance. The prevailing force of the market was now his ally. To abandon a position that had such powerful validation was an act of strategic cowardice. This was the time for courage. This was the time for hope. This was the time for sitting tight. This concept of sitting tight was the offensive cornerstone of his entire philosophy. He famously stated, "It never was my thinking that made the big money for me. It always was my sitting." He had the almost superhuman patience to hold a winning position for weeks, sometimes months, riding a great trend through all its minor nerve-wracking reactions. This patience was not a passive act. It was an active and courageous expression of his intelligent hope. He was hopeful that the great trend, which the market itself had confirmed, would continue to run its full, logical course. He immortalized this principle in the story of the wise old trader, Partridge, who, when urged to sell a winning stock in a roaring bull market, simply replied, "Well, you know this is a bull market." It was a statement of profound simplicity and power. It was the voice of a man who had learned to trust the primary trend, to have hope in the continuation of a great move, and to not be shaken out by the fearful, meaningless noise of the day-to-day fluctuations. This is the balance that Livermore mastered. He channeled the destructive energy of his own natural emotions and transformed them into powerful strategic tools. He took fear, the paralyzing force that keeps a man chained to a loser, and he forged it into the disciplined scalpel that cuts losses with precision. He took hope, the siren's call that lures a man into averaging down his mistakes, and he transformed it into the intelligent, patient courage that allowed him to ride his winners to their magnificent conclusions. He feared where the amateur hoped, and he hoped where the amateur feared. For the modern trader, this is the ultimate lesson in the mental game. It is a call to engage in a conscious and deliberate process of self-mastery. You must learn to recognize your own emotional impulses not as guides, but as contrary indicators. When you are in a losing trade and you feel the comforting warmth of hope, you must recognize it as a danger signal. It is a sign that you are substituting wishful thinking for reality. Your action should be driven by a rational fear of a greater loss. You must sell. Conversely, when you are in a profitable trade and you feel the cold grip of fear, the anxious urge to snatch your profit before it disappears, you must recognize this as a signal of a different kind. It is a test of your courage. It is the moment to consult your analysis, to look at the trend, and if the conditions are still sound, to have the intelligent hope that the move has further to run. You must learn to sit tight. This is the great and difficult work of the speculator. It is to go against the grain of his own human nature, to act in a way that feels at first completely unnatural. But it is the only path to lasting success. The market is a mirror of mass psychology, and the man who is a slave to his own emotions is no different from the crowd he is trying to beat. To achieve extraordinary results, one must learn to think and act in an extraordinary way. This balance of fear and greed, this masterful inversion of hope, was not a gift that Livermore was born with. It was a skill he acquired, a discipline he forged through years of painful failure and relentless self-analysis. He learned that the ticker tape was not just a register of prices. It was a reflection of human emotion on a grand scale. And he learned that to profit from that emotion, he first had to become its master, not its victim. This was the true source of his genius, the secret to the mental game that he played better than any man who came before or after him. It is the state of mind that follows a series of painful losses, a desperate, irrational compulsion known as chasing losses. It is the moment a speculator ceases to be a calculated businessman and devolves into a reckless gambler, his judgment clouded by the singular all-consuming desire to win back what the market has taken from him. This is the great siren's call of financial ruin, and the man who fails to recognize it, who cannot master the impulse to fight back against the tape, is doomed to be wiped from the board. Jesse Livermore, the most formidable speculator of his age, was not immune to this affliction. He was, in fact, its most famous and recurring victim. He acknowledged, with the brutal honesty of a man who had paid for his knowledge with millions, that his greatest and most catastrophic losses were never the result of a flawed analysis or a faulty premise. They were the direct consequence of trading while in an emotional, irrational state of mind. He knew that when a speculator begins to trade not on what the market is doing, but on what he needs the market to do to erase his previous mistakes, he has already lost the game. The descent into this state, what modern traders call tilt, is a subtle but swift one. It begins with a loss, then another, and another. The carefully constructed confidence of the speculator begins to crack. Frustration gives way to anger, and anger to a desperate impatience. The calm, dispassionate analysis that is the hallmark of the professional is replaced by a hot, feverish need for immediate action, for a quick and decisive victory that will restore both his capital and his wounded pride. He abandons his tested principles and surrenders to pure, unadulterated hope, the most treacherous of all emotions in the ticker district. For those who are committed to a deeper, more methodical study of the principles that governed Livermore's legendary career, the essential text remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. The first and most dangerous symptom of chasing losses is the abandonment of sound money management. The speculator, needing to recover a significant deficit, makes a fatal calculation. He concludes that the only way to get back to even is to increase his bet size. A small, prudent position is no longer enough. He must now risk a disproportionate amount of his remaining capital on a single trade, believing that a single win will solve all his problems. He forgets that this same logic magnifies his risk of a final, account-annihilating blow. He is no longer managing risk, he is courting disaster. Livermore knew this trap intimately. After acquiring a large fortune, he would sometimes become careless, taking liberties with the market he would never have dared to take when he was climbing his way up. He admitted that the speculator's chief enemies are always boring from within. The weaknesses that all men are prone to, greed, fear, and especially hope, are fatal to success in speculation. When chasing losses, these enemies are no longer just present, they are in command. The second symptom is the complete disregard for one's own proven rules of engagement. The very principles that led to his past successes are cast aside in the heat of the moment. The rule of cutting losses quickly is replaced by the desperate hope of averaging down, a practice Livermore deemed financial suicide. The discipline of waiting for a clear signal at a pivotal point is replaced by an anxious, impulsive need to be in the market at all times, to force a trade where no true opportunity exists. He recounted times when he would permit impatience to outmaneuver good judgment. He wanted to have an interest at all times, a common weakness among all speculators. But he learned that this hankering for activity was most pronounced and most costly when he was trying to recover from a losing streak. He was no longer trading to make money, he was trading to get even. And the market, he knew, is a terrible and expensive place to seek revenge. This emotional state transforms the ticker tape from a source of objective information into a personal antagonist. Every uptick against his position feels like a deliberate insult, every downtick a confirmation of his failure. He is no longer reading the market. He is fighting it. He is arguing with the tape, a battle no man has ever won. The market is never wrong, opinions often are, but the trader chasing his losses cannot accept this. His ego is on the line, and he is determined to prove that he, not the market, is right. Livermore's own words on the matter are a chilling testament to the danger. He confessed that when a man is wrong and knows he is wrong, but holds on because he cannot bear to accept the loss, he does damage not only to his pocketbook, but to his soul. It is this psychological damage that makes a comeback so difficult. The mind of the speculator must be clear, his nerves steady, and his approach dispassionate. When chasing losses, his mind is a chaotic storm of regret, hope, and fear. In such a state, he is not fit to trade, and every decision he makes is almost certain to be the wrong one. He once described a period of his life where, after a devastating loss in cotton, he persisted in trading while his mind was not right. He was sick, nervous, upset, and unable to reason calmly. He confessed that this was the very frame of mind in which no speculator should ever be when he is trading. The result was inevitable. Everything went wrong. He kept on trading and kept on losing, digging himself deeper into a hole, each new loss fueling a more desperate desire to recover. It is a vicious, self-perpetuating cycle of ruin. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Furthermore, we recognize that the wisdom of the markets is not confined to a single individual. The history of speculation is rich with masters who, while sharing Livermore's core respect for risk, developed their own unique styles. From the mechanical box theory of Nicholas Darvas, to the volume spread analysis of Richard Wyckoff, to the turtle trading system of Richard Dennis, from the pioneering trend analysis of Charles Dow, to the modern psychological insights of Ed Seykota, there is a pantheon of genius to study. To explore this rich history, we have launched a new channel dedicated to the diverse strategies of the world's greatest traders and investors. If you wish to broaden your understanding, the link to this new channel is in the description below. The great danger of chasing losses is that it fundamentally alters the speculator's relationship with the market. He is no longer a student, patiently observing and waiting for high-probability opportunities. He becomes a pursuer, a hunter, desperately trying to force the market to give him what it does not have to give. This turns the entire process on its head. He is no longer trading the market as it is, but as he wishes it to be. This is the definition of wishful thinking, and in Wall Street, wishful thinking is a terminal disease. Livermore knew that a man must never lose his poise, his sense of balance. He must remain an impartial observer, analyzing conditions without emotion. But after a string of losses, this detachment becomes almost impossible. The losses feel personal. The market seems to be singling him out for punishment. He loses his perspective. He cannot see the great, sweeping trends because his vision is entirely consumed by the small, agonizing fluctuations of his own losing position. The market, in its impersonal wisdom, offers no solace. It does not know or care that a trader is down on his luck. It continues to move along the line of least resistance, a path that is often directly contrary to the desperate hopes of the man who is chasing his losses. In fact, his own irrational actions often contribute to his demise. His oversized, ill-timed trades provide fuel for the very trend that is destroying him. He becomes an unwitting accomplice in his own financial execution. This is the ultimate tragedy of the trader caught in this cycle. He is not beaten by an external force, but by a flaw within himself. He knows on some level that he is breaking his own rules. He knows he is being reckless. He can feel the knot of anxiety in his stomach, the frantic, desperate energy that has replaced his former calm. Yet he is unable to stop. He is trapped in a psychological prison of his own making, a prisoner of his past mistakes, forever chasing the ghost of his lost capital. Livermore experienced this prison, and it is from the depths of that experience that his most valuable lessons on mental discipline were born. For the speculator trapped in the chaotic storm of chasing his losses, every instinct screams for more action, for a faster, more aggressive fight against the market that has wronged him. He believes the solution lies within the ticker tape, in one more trade, one final heroic bet that will reverse his fortunes. But Jesse Livermore, having walked this path to ruin and back again, discovered a truth of profound and paradoxical power. The only winning move in this desperate game is not to play at all. The secret to resetting the speculator's mind, to breaking the cycle of emotional ruin, is found not in a more complex strategy, but in the radical, disciplined act of doing nothing. When Livermore found himself in that dark psychological space, his judgment clouded and his actions dictated by desperation, he did not double his stakes. He did not seek out a new, more potent tip. He did not redouble his efforts to outsmart the market. He did the one thing that felt most unnatural, yet was most essential. He stopped. He would physically and mentally remove himself from the battlefield. He would leave Wall Street behind with its incessant, maddening click of the ticker and its chorus of hopes and fears. He would retreat, not in defeat, but in a strategic maneuver to save himself from himself. His chosen sanctuary was often the quiet solitude of a fishing trip. Away from the frantic energy of the brokerage office, out on the calm, open water, the noise in his mind would begin to subside. The frantic need to get it back now would be replaced by the patient rhythm of the tides. The market, which had seemed like a personal antagonist, would recede into the distance, becoming once again an impersonal force to be studied, not a monster to be fought. This physical separation was a crucial part of the cure. It broke the vicious feedback loop of loss, anger, and desperation. In this self-imposed exile, with his mind free from the immediate pressure to act, he could begin the real work of recovery. He could analyze his mistakes with the cold, detached clarity of a surgeon examining a case study. He could see, without the distortion of ego or the panic of the moment, exactly where he had deviated from his own proven principles. He could identify the precise moment that calculated speculation had degenerated into a reckless, emotional gamble. He was, in effect, performing a post-mortem on his own flawed decision-making. This period of reflection was not about self-flagellation. It was about re-establishing his intellectual and psychological foundations. He understood that a speculator's greatest asset is his clear, unemotional mind. When that asset is compromised, to continue trading is to operate with faulty equipment, an act of pure self-sabotage. The pause, the retreat, was his way of taking that equipment offline for repair. He would not return to the game until he was certain that his mind was once again his ally, not his enemy. He would wait until the desire to trade was replaced by the intellectual conviction that a true, high-probability opportunity had presented itself. He would wait until the anxious need for action was gone, and in its place was the calm, intelligent patience of the professional. He would wait until he could once again view the market not as a vehicle for personal vindication, but as a fascinating problem in probabilities. This process might take days or it might take weeks. The timeline was irrelevant. He would not return a moment sooner. Upon his return to the market, he did not come back with a roar, seeking immediate revenge. He came back with a whisper, with the utmost caution and humility. His first objective was not to win back his losses. That, he knew, would come in due time if he traded correctly. His first and only objective was to re-establish the habit of discipline. He had to prove to himself that he was once again the master of his own emotions and the faithful servant of his own rules. This meant returning to the foundational principles of his success. His first trades after a reset were always small, what he called probing commitments. He was testing the market, yes, but more importantly, he was testing himself. Could he cut a small loss without hesitation if the trade did not act right? Could he resist the temptation to average down? Could he wait patiently for the market to confirm his judgment before adding to his line? These small, disciplined trades were his way of rebuilding his confidence on a foundation of sound practice, not on the quicksand of a single lucky win. His legendary comeback in 1915 is the ultimate testament to this method. After years of being in debt and out of the game, he was given a small credit, enough to trade just 500 shares. He was a man who had once swung lines of 100,000 shares, now reduced to a piker's stake. The temptation to take a massive risk, to try and get back on his feet with one heroic play, must have been immense. But he did the opposite. He did not make a single trade for 6 long, agonizing weeks. He sat day after day watching the market, studying, waiting. He had identified Bethlehem Steel as the great opportunity of the day, but he refused to act on his opinion alone. He waited for the market's own unequivocal confirmation. He waited for the stock to cross the critical pivotal point of $100. In those 6 weeks, he watched the stock climb from the 50s to the 80s to the 90s, every point an agonizing reminder of the profits he was foregoing. But he was not trading for points. He was trading to re-establish his career, and that required perfect, flawless discipline. When the stock finally broke through par, he acted, and the resulting profit gave him the stake he needed to begin his great comeback. But the real victory was not the money he made. It was the discipline he had demonstrated. He had proven to himself that he could conquer his own impatience, that he could wait for the perfect moment, that he was once again the master of his craft. He had not chased his losses from the previous years. He had waited for a new and certain opportunity to present itself. This, then, is the practical solution for the modern trader who finds himself trapped in the cycle of chasing losses. The moment you recognize the symptoms, the oversized bets, the ignored stops, the desperate need to get even, you must stop. Close your platform. Walk away from the screen. It is not an admission of defeat. It is the highest form of strategic wisdom. You are recognizing that your mind, at this moment, is your greatest liability, and you are refusing to let it do any more damage. Take a break. The length of the break is determined by the severity of the psychological damage. It may be a day, a week, or a month. But during that time, you must detach completely. Do not watch the market. Do not read financial news. Do not think about your losses. Your goal is to let the emotional storm pass, to allow the waters of your mind to become calm and clear once again. Use that time to study, to return to your first principles. Reread your own trading rules. Study the methods of the masters. Remind yourself that speculation is a business of probabilities, not a game of emotional impulses. Your goal is to return to the market not as a wounded gambler seeking revenge, but as a rested, clear-eyed businessman ready to execute a sound plan. When you do return, you must do so with extreme caution. Your first objective is not profit, but the flawless execution of your own rules. Start with the smallest possible position size. Your goal is to log a series of small, disciplined trades, some wins, some losses, but all of them executed in perfect accordance with your plan. You are rebuilding the habit of correct action. You are rewiring your brain for discipline. Forget the money you have lost. It is a sunk cost, a tuition fee paid to the school of Wall Street. To try and win it back is to ensure you will lose what remains. Your focus must be entirely on the future, on the next trade, on executing it perfectly, on protecting the capital you have now. The profits will come, but only after discipline has been fully restored. This is the secret to stopping the chase. It is the understanding that the cure for emotional trading is not more trading, but a temporary absence from it. It is the recognition that a strategic pause is not a sign of weakness, but of ultimate professional strength. It is the discipline to step away from the battle to allow yourself to heal, so that you can return not as a desperate soldier, but as a calm and prepared general, ready to lead your capital to victory. This was Livermore's way, and it is the only way to ensure survival and eventual triumph in the great and unforgiving game.